Hi everyone, in this video we're going to talk about the classified balance sheet. You see on the screen a sample of just different accounts and their balances for Barrios Company. This is as of the end of the current year, December 31st. Before we get started on the classified balance sheet, let me remind you the income statement accounts include a listing of the revenue and the expense accounts, and it is on the income statement that you present either net income or net loss. Statement of retained earnings would be the second statement you prepare because the net income or loss has to roll into that statement. In this statement of retained earnings, you would also present the dividends for the time or the period that you're talking about, and then the balance sheet. The balance sheet accounts include all assets, liabilities, and equities. They do not include revenue, expense, or dividend accounts. Those have already been presented on other statements, so you do not present them on the balance sheet. Assets, liabilities, equity accounts. When we say classified balance sheet, what we mean is we are just classifying or separating, grouping items, accounts, and their balances by current and non-current amounts and accounts. Not amounts, just accounts. And so by current and non-current, that would be the deciding factor is typically 1 year or the company's operating cycle, whichever is longer. Typically, we look at 1 year. So you see all of these accounts listed in no particular order on the screen. They're mixed up. You have income statement accounts, you have your retained earnings, your dividends, all your balance sheet accounts are on there as well. So before we can classify the balance sheet, let's pick out the accounts that we would need. Accounts payable, those are items that a company needs. That is definitely a liability. Accounts receivable, in fact, let me just I'll just put some lettering in here for you. So this is a liability account. Your accounts receivable is an asset. Accumulated depreciation. These accumulated depreciation accounts pair up with an asset account on the balance sheet. We call those contra asset accounts, so they definitely do go on the balance sheet. All three of these accumulated depreciation accounts are going to go to the balance sheet as a contra asset. And then we have automobiles, buildings, all of these are assets. Your common stock is an equity account. It would show up there as well. Cash is certainly an asset account and it's going to go there. Commissions expense. This is, I'm going to just come over on the left side, I think, so we can see which ones go to the classified balance sheet that we're going to be preparing as well. Let me get this up a little larger so you can see it. Make sure you go to full screen if you need to be able to see some of these numbers. Okay, commissions revenue, well that one tells us it is a revenue account, and we know because we just discussed those types of accounts. It would show up on the income statement. It is not going to show up on the balance sheet. Dividends comes next, and of course dividends is a dividend account. Whoa, didn't mean to do that. Okay, equipment is an asset account. Utility expense, this is an expense account. It's expense for income tax. Income tax payable, we have to pull that one in because that is a liability account. The interest revenue, so this company has two different revenues and that's fine. Land is an asset account. Note payable due in 5 years. So this note payable is also a liability account. Office salary expense is an expense. Office supplies, this is your asset account. These materials or supplies have not been used up yet, so they are an asset for the company. Retained earnings is an equity account, so it is also going to show up on this classified balance sheet. Okay, so all the items that we have listed in this column you see as classified as first as an asset, even a contra asset, liabilities, equities, all of these accounts are going to make their way to the balance sheet. And again, we are going to classify those amounts. So I've already done that on the next sheet. Okay, here we have a balance sheet for Barrios Incorporated, and this incorporates all of the numbers and the accounts that we saw on the screen with our data previously. So notice on the left-hand side you see an overall heading for assets. On the right you see liabilities, and underneath that stockholder equity. This is called a count form when you have assets on the left, liability, stockholder equity on the right. I am displaying like this simply because of my screen. I want you to be able to see the whole balance sheet at one time. When you list it all vertically like you would do in real life and like you might do in class, then that is called report form, and that's the way you usually would see it. But for our purposes and for this video, it's shown in account form. So notice on the screen over on the left the assets. Underneath that you see a header or a label for current assets. So remember, current assets are those items that will become liquid, turn into cash, be used up, or expire within a year usually, or the operating cycle, but usually a year is what we're going to be concerned with. These items are listed in order of liquidity, so cash is always listed first. In our case, then, we follow that with accounts receivable. Remember, accounts receivable are those amounts owed to the company by customers. And then office supplies. This is your asset account. This is not supplies expense. These are the supplies that are still in the cabinet or the closet and haven't been used up yet. After that, you'll want to total those current assets, and so I used Excel to do this. If you look up here in the formula bar, you'll just see that I put in equal and then type in the word sum, open parenthesis, and then select the sales you want to include, and then close the parenthesis, and it will calculate this for you. So it makes it really easy to get that math correct. Also notice you do not go crazy with dollar signs. I'm starting each side with a dollar sign. I'm ending with a dollar sign. You could do it at the different divisions, but for simplicity, I'm just going to go with start the column and end the column. Next area is called property, plant, and equipment. Sometimes you might hear this called plant assets. You might also hear it called fixed assets. It depends on the company you work for or your textbook. Different authors have different favorite terminologies. It's the same thing, whatever it's called. I chose to call it property, plant, and equipment for this video. And this is where you're going to list all of those long-lived assets, those items that have hopefully a life beyond a year, so they have a longer lifetime. First we have land. Also remember that land is never depreciated, so there is not an accumulated depreciation account that goes with land. I brought it straight over, the full amount straight over to the column underneath current assets. I'm starting a new total, but I wanted to bring that over. Next, I'm going to list each of my long-lived assets, and with them, with each one, there is an accumulated depreciation account that corresponds to it. For instance, accumulated depreciation for auto, so that accumulated depreciation account stands alone. For buildings, there is an accumulated depreciation account that pairs up with that one. For equipment, there is one that pairs up with that one as well. So we present it on the balance sheet as just like you see here. So let me just put in the formula. So I'm going to say take the full amount of automobiles and then subtract the amount, well, I've got to say plus because I've got it listed as a negative, so double negative will make it add. Put these two together and it does the math for you. Double click and you'll see that it's there. Same thing with the next ones. You can, I'm not going to use Excel formulas here, but the 151,000 minus 1,000 leaves 150. The equipment 87,000 minus 2,000 leaves 2,000. It leaves 85,000. Now I want to total those four items, my automobiles, buildings, equipment, land, all of those property, plant, and equipment net items. They have been netted by the amount of accumulated depreciation in each account. So we have a total property, plant, and equipment. And now I want to add the total property, plant, and equipment to the total current assets, and that is going to give me my total for all the assets. We don't say total all assets, we just say total assets. We end this column by double underlining, which you can do that in your home screen here for underline. If you go up the top, you see your double underline. If you're using Excel or if you're using pencil and paper, then you just draw two lines there. Actually, you would have done that when you finished this, but you know you're in balance at this point, because if you're not in balance, you're going to go back and figure out why you're not in balance and get it in balance. Over on the right-hand side, now we have our liabilities section. Remember, assets are those items a company owns. The liabilities are those amounts that they owe on those assets, possibly. So first we'll have current liabilities. Current liabilities follow the same pattern as current assets. These are amounts that are going to require resources of the company to be paid within a year or the operating cycle. So within a year, we have accounts payable. Those are typically due within 30, 60 days. Income tax payable, certainly that's going to need to be paid to the IRS or state pretty quickly too. So we only have the two, so we total those up, the $76.50 plus $2,500. Total that up. Use your formula if you like. So I'm saying equals sum. Open the parenthesis, select your items, close parenthesis, enter, and there you have it. And so if you want to see that, you can replay this and stop or speed up as you need to. I'm not going to extend the video by just keeping on. Okay, next we have a long-term liability. You would be able to identify this by if you're working in the real world, then you'll know when this is due, or your problems will tell you. So in this case, the note payable is due in 5 years, so that's certainly going to be longer than 1 year. And I just went ahead and put the long-term liability total in here. If you have just one item, that's an optional label to put in. Next, we want the total of all liabilities. Let me take that underlining out. So the total of the current liabilities plus the long-term liability. Yeah, let me change that to 12 because initially I didn't have one in there. So the total of all liabilities, $100,150. Next section is stockholder. Remember, your stockholder equity has two parts. Paid in capital, which we call this the common stock. If there were preferred stocks, other stocks, that would come under that heading as well. And then retained earnings, which are those amounts that have been earned by the company and are still retained or held within the company. So adding these together, we get the total of, take that out too, we get a total of $210,375. Next, I want to add together, remember, the total of liabilities and stockholder equity. So this is equal to all of the liabilities plus all of the stockholder equity, and we end up with $310,525. So we're definitely in balance. The total of all assets must be equal to the total of liabilities plus stockholder equity at any given time. Otherwise, we are out of balance. So we are in balance here, and that's where we want to be.